Be Wealthy and Smart, episode 302.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, you're going to learn why 7 billionaires are worried about a stock market correction. But first, this episode is brought to you by Audible. It's the way I read more books and stay ahead of the curve. Audible is, of course, the easiest way to read books because all you have to do is just listen, like you are right now. There are over 150,000 titles to choose from for your iPhone, Android, Kindle, or MP3 player. And your first audiobook is free. Just visit audibletrial.com/be wealthy and smart. I appreciate your support of this podcast. Just go to audibletrial.com/be wealthy and smart. Recently, I came across an article about why 7 billionaires are worried about a stock market correction. And frankly, I've been thinking we are way overdue for our usual 20% correction, which we have always had one every 10 years. Well, we're running out of that 10-year period of time and we haven't had a 20% correction. So I think we are a bit overdue. I've been expecting something to happen, but we have now 7 billionaires saying they're expecting something to happen as well. So I wanted to share this article with you from MarketWatch. And I will also put a link to this in the show notes and on my website. It says, opinion, these 7 billionaires are worried about a stock market correction. And it mentions Jeff Gundlach, Carl Icahn, Howard Marks, Warren Buffett, George Soros, David Tepper, and Paul Singer. So the article goes like this. And by the way, this is by Jeff Reeves, a columnist at MarketWatch. By now, all investors should know the research about the follies of market timing. But similarly, all investors should admit that a quest for outperformance by stock picking and active management will never end, particularly given that 2017 shows more than half of active funds are beating their benchmarks for the first time since before the Great Recession. So it's worth noting that a host of big-name billionaire investors are pretty concerned about current market conditions. Yes, there are tremendous benefits to passive, low-risk, long-term investing strategies, and obviously some of the best investors on Wall Street often get things painfully wrong. But when some of the biggest and most respected hedge funds are pumping the brakes as the Dow Jones Industrial Average and the S&P 500 have hit new all-time highs this week, and the NASDAQ Composite isn't far off, well, it seems plain irresponsible to simply write that off. Here are what 7 of Wall Street's most iconic investors have to say about the market and the potential for a correction in the next several months. Jeff Gundlach advises, quote, moving toward the exits. Double Line Capital CEO and bond guru Jeff Gundlach is reducing his positions in junk bonds, emerging market debt, and other lower quality investments on a fear that investor sentiment may roll over in the near future with painful effects. That probably won't manifest in a huge drop over a short period, Gundlach predicted, but it's wise to prepare nevertheless. Quote, if you're waiting for the catalyst to show itself, you're going to be selling at a lower price, he told Bloomberg recently, instead of recommending investors begin, quote, moving toward the exits. The second billionaire is Carl Icahn. He warns stocks are overvalued. Investing icon Carl Icahn has made that's a little investing pun. Carl Icahn, ha ha ha, has made plenty of bold, bullish calls in recent years, including a winning bet on Herbalife, despite a lot of negative press at the time. However, Icahn generally isn't seeing a lot of opportunities given how much stock prices have run up. Quote, I really think now I look at this market and you just say, look at some of these values and you have to wonder, he told CNBC in June. The next billionaire is Howard Marks. He warns clients of, quote, too bullish territory. In a late July note to clients, billionaire Oaktree Capital founder Howard Marks used one of his popular memos to warn about the chance of a correction. You should read the whole piece about the formation of bubbles, market cycles, and about the importance of caution right now. But in a nutshell, he warns aggressive investors are, quote, engaging in willing risk-taking, funding risky deals, and creating risky market conditions, and that this has been a hallmark of past downturns. The next billionaire is Warren Buffett. He says, when you think of corporate cash hoards, Apple normally springs to mind, not Berkshire Hathaway, the conglomerate known for big deal making. Unfortunately, those deals haven't materialized, and the company that Warren Buffett built has seen its stockpile soar from under $40 billion in the second quarter of 2013 to nearly $100 billion in cash at the end of June. That is telling, considering the Oracle of Omaha's adage that, quote, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Despite all that cash, apparently Buffett and company don't see many opportunities either to buy wonderful companies or to get them at fair prices. Our next billionaire is George Soros, who gets bearish in a big way. George Soros recently sold stocks and bought gold in anticipation of a big downturn. Admittedly, the billionaire investor jumped the gun with a bleak outlook for stocks, warning right after Trump's election that global markets were in trouble, a call that was clearly incorrect. But Soros made a name for himself for a reason, so that he is doubling down again on this call is at least worth acknowledging. The next billionaire is David Tepper, who is, quote, on guard. The hedge fund guru behind Appaloosa Management isn't leaning to the short side just yet, but is far less bullish than just several months ago. He has even suggested wary investors put some money in cash if they don't like the frothy valuations on Wall Street right now. Tepper was particularly concerned about central bank intervention over the last several years distorting bond markets and how that is influencing stocks in a way that could lead to trouble. The next billionaire is Paul Singer, who warns of an ETF crisis. Admittedly, hedge fund icon Paul Singer of Elliott Management has a personal stake in the fight against passive ETFs, given the active strategies pursued by his firm. However, Singer's recent warning on CNBC that passive funds could create an inflexible trend that leads to a market-wide sell-off is worth listening to. Quote, it means that at one point, you will not have the active end in the market to stabilize it. You would have just the passive guys getting into herd mentality, Singer said. In other words, if sentiment takes a hit, it will be dramatic, and no amount of bargain hunting or logic about fundamentals will help cushion the blow. That's the end of the article, and again, I will leave a link in the show notes and on my website. So basically, you have different billionaires who are talking about the market looks expensive, it looks overvalued, or perhaps that it's time for a pullback, or in this last case, maybe even that passive investors will all get spooked at the same time and hit the sell button. You know, in 1987, we had a huge crash, about 23% decline in one day. Markets just started selling off, and they went lower and lower and lower until at the end of the day, they were 23% below where they started the day. It was a frightening, huge sell-off. And there really wasn't any particular thing people could point to other than the fact that interest rates started to rise quickly, and we had a lot of program trading. We had a lot of automated computer programs that hit the sell button at the same time. And that kind of waterfall selling comes from everyone selling at the same time and no one stepping in to buy. So the point that there aren't more active managers is what Paul Singer is saying is going to be making it difficult for the market to have any buyers, any active managers who would be buying low and who would be coming in and offer prices to buy, because these waterfall drops that happen because there are no buy orders. So if everybody pushes the sell button at the same time and continues to push the sell button and no one is stepping in to buy, that just means the market goes lower and lower and lower until you find buyers coming in. So he's warning that passive investors may just all head for the exits at the same time, and if that happens, we could have a much sharper drop than people normally anticipate. But I want to remind you that it's perfectly normal, that once every 10 years we have a 20% correction in the market. So we're overdue for our 20%. We're almost out of a 10-year period. We've never had a 10-year period in history where we haven't had a 20% decline. So we're due. It would be totally normal for the market to drop 20% here sometime this fall. I'm not saying it's going to happen tomorrow, and neither are these managers. But I think it's something to note when 7 billionaires who are very, very astute, obviously with money, very well tuned into markets, and very expert with the highest levels of research and resources at their fingertips regarding the markets, it's a good thing to just pay attention to what they're saying, maybe become a little bit more cautious, a little less aggressive, maybe raise a little bit of cash in your account and have some available in case we do have a dip and you can buy low. Because stocks are, as Warren Buffett says, the only thing that when it goes on sale, nobody seems to want to buy them. And if you can step in and buy when stocks are low and people are terrified, that's the best time to get some really good deals. Have you heard I'm having a summer sizzle giveaway? It's now through the end of September, and in early October I'll have a drawing and you could win 6 awesome prizes. 5 of them are Wealthy Mindset Blueprint audio courses worth $197 each, where you can learn how millionaires and potential millionaires think the right thoughts for wealth before it happens and how you can do that for yourself. Or you could win one of my wealth journal books and learn the 6 steps to wealth and have my wealth mini course, which is worth $67. Here's all you need to do. Just leave a review for Be Wealthy and Smart on iTunes or Stitcher Radio. iTunes if you have an iPhone, StitcherRadio.com if you have an Android. That's STITCHER radio.com for Android. Leave a review. Then join me on social media. If you're on Twitter or Instagram, I'm at Linda P. Jones. On Facebook, I'm at Linda P. Jones fan page. And then send me an email and let me know you did it. I'm at lpjhome@gmail.com. In early October, I'll have a drawing, and if I draw your name, you're a winner. It's that simple. And if you're ready to get your net worth moving in the right direction, get my 11 quick financial tips to boost your wealth. There are 11 quick things anyone can do to get to financial freedom faster. It's at lindapjones.com. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.